Our next speaker is the Executive Director at Bitcoin Foundation and Managing Partner at Newtown Partners. He's the go-to market strategist with almost 20 years of expertise in crypto, digital product management, and digital marketing. Here to present the crypto economic design choices in decentralized networks, the age of decentralized applications, please give a warm welcome to our next speaker, Llew Claasen. Round of applause for Llew Claasen, please.
Good afternoon, Singapore. Thank you for hosting me. So today, I'm going to talk a little bit about the economics of decentralized networks. And I think that our starting point is kind of this realization that my business partner and I have been investing in blockchain startups for the last sort of 4 years. And over that time, it's been very interesting to see how investor preferences have changed. So initially, deals were being done with pure, straight-up equity instruments. Later, they became done in convertible instruments. 2017, 2018 was largely dominated by investor preference for highly liquid utility instruments. And then at the end of 2018, we kind of go full circle right back to the deals that are currently being done are mostly, but not exclusively, being done in equity instruments. And I think this tells us quite a lot about the state of our industry, and more specifically, the fact that these asset prices are so highly correlated with each other at the moment that my contention is that most projects haven't spent enough time thinking about the economics of how to do these token issuances, and that we should be paying much more attention to this kind of thing. And so let's just have a quick refresh on what we're talking about here. We're essentially talking about the production, distribution, and consumption of goods and services and how people meet their needs and wants within an economy. And you can take a macro view on that, you can take a micro view on that. And so today I'm going to talk a little bit more about the micro view and how that influences DApp architecture. And our story kind of starts a couple of thousand years ago, where humans were predominantly sort of organized in small tribes, not a lot of commerce going on. And so occasionally what would happen is that somebody would arrive and they had items to sell, and our tribe would effectively consume as much of that as possible to meet those needs and desires. And so you had a situation where demand exceeded supply. And so the producer, or the seller in this particular case, was able to capture that economic surplus. If we then fast forward to the end of the Second World War, we find that there were a relatively large group of people who had unmet needs and desires, but a much larger group of people who were at that point in time capable of production of these goods and services, predominantly because you had excess production capacity left over after the Second World War. And so you suddenly had a situation where supply, in fact, exceeded demand. And so you had consumers that were capturing that economic surplus. And you saw the emergence of industries like the advertising industry to try and close that gap. And not much changed until we suddenly get to the age of the internet. And what the internet enabled us to do is to create two-sided marketplaces where you suddenly had producers on the one side, consumers on the other side, and you had technology that was able to mediate those relationships and provide trust in those interactions. And so these trusted intermediary two-sided marketplaces could use effectively cross-side and same-side network effects in order to create these winner-take-all markets where there was effectively equivalence between demand and supply, but that the trusted intermediary suddenly was capable of capturing that economic surplus. But what decentralized networks enable us to do is to have a relationship between producers, consumers, and ultimately break up what was previously performed in terms of function by these trusted intermediaries and let them have a function as well in a decentralized network. And through design, we can now create these lattices that effectively govern relationships between participants using economic and non-economic incentives. And what you can also then have is a situation where, although supply and demand are equivalent, nobody is capable of capturing that economic surplus. And using mechanism design, which is a branch of game theory, you can now actually do targeted incentives that enable you to influence the strength of network effects at any point in time in that network. So we can create much more scalable, much more economically efficient ways of coordinating economic activity using decentralized networks. And so I want to talk a little bit about some of the projects that I've either been an investor in or otherwise an advisor, and what that tells us about this emerging area of microeconomics in the space, in the context of crypto. And the first project I want to talk about is Civic. And Civic is a decentralized identity management platform, which has three primary stakeholders. And the relationships between those stakeholders are governed in this network in a way where the network is able to produce high-quality, reusable identity information despite the fact that there is no oracle, there is no arbitration function, and in fact, the network assumes that it will have incomplete information. And so it tells you a little bit more about where we are in the state of microeconomic design, that we can now use these economic and non-economic incentives, both on the reward and on the penalty side, combined with staking mechanisms in order to govern relationships between these market participants. The next project that I want to talk about, and where I'm an advisor, is something called the Fan-Controlled Football League. And it is exactly what you think it is. So Q2 2019, there is an indoor football league launching in Las Vegas. It's going to have 8 teams. And the proof of concept for this was run at the end of 2017 in Salt Lake City. And the principle behind this is basically that fans make all the decisions, both at the league, at the team, and even at individual play levels, using a crypto-economic system. And so I'll come back to some of the other elements of the design for the Fan-Controlled Football League, but suffice to say that one of the things that is embedded into these economic designs, particularly when you're trying to create real utility in these networks, is to create a work function. And what this work function effectively does is define what the work is that you're expecting network participants to perform, and then for every cycle, newly minted coins or tokens are distributed according to the way that that work was performed. Now, this might sound to you like not a big deal, but this is actually a far more efficient way of allocating economic benefits compared to the way that we do it today, which is who put the money in rather than who actually did the work that created the network value. So decentralized networks are actually better ways of coordinating economic activity compared to our best example that we have today, which is a two-sided marketplace. So crypto assets, for most of 2017 and 2018, we've had this debate about what exactly are we talking about here. Are these things currencies? Are they commodities? Are they securities? Or do we have something new called a utility? And how does that influence market participants' behavior? And I think that where we are right now is this realization, including at a regulator level, that in fact these new assets represent and have the characteristics of all the other asset classes combined. And so it depends entirely upon how you're using these crypto assets rather than them having some kind of inherent characteristics that define them. So for example, if you take a utility token, which for a large part of 2018, this consideration was, is this a security instrument, and how long is it going to take before regulators kind of latch onto this idea? And the reality is that if you have a well-defined and well-designed utility token, even if you start to apply principles like the Howey test against it, you realize that it does not look at all actually like an equity security. And to the extent that it does, it usually reflects poor design. So crypto assets are actually all the other assets in addition to being a new asset class. So 2017 and beginning of 2018 was characterized by this ridiculous FOMO, this ridiculous speculative investing spree that wasn't driven by any kind of fundamental behavior. And further, it was made even worse by massive volatility that was taking place in the market. Now, it is possible that volatility is in fact a reflection of the fact that our industry is so immature, and that, for example, if you look at how gold trading markets evolved over time, that a lot of that volatility will be removed over time. But there is also other data, in this case from the St. Louis Fed in the USA, which tells us that even in very stable economies like the US and Japan, there is still volatility that exists in forex markets. So it is possible that financial instruments cannot get away from the fact that there is always going to be volatility as long as there is information asymmetry. And so initial attempts to be able to price these things, and why is pricing important, is because you're more likely to have a situation where these asset prices are not highly correlated with each other if you can make a determination about the value of a specific token compared to another coin, rather than that they're somehow all related to each other based upon trading pairs. And so initial attempts at pricing these assets focused on the use of something called the equation of exchange, and this realization that you had a monetary economy and you had a real economy, and they were kind of equivalent to each other, and that you could manipulate that equation to determine how to influence the price of a unit, and in fact, to do something called the discounted utility value model. I wasn't comfortable with this method because I felt like it focused too heavily on the financial use case or the currency use case, and so I started to look at forex markets and said, well, if we looked at the drivers of forex exchange rates, what might that tell us about some of these assets? And in fact, what I found is that if you do apply that and you remove those that relate specifically to debt and intra-project trade, and you add speculative investing in there, then there really are 4 key drivers for crypto asset prices. And they are certainty around the supply schedule, governance participation, network utilization, and the unfortunate reality of speculation. And so crypto assets are very difficult to value. We still don't have a really good way of valuing them, but we're getting better at it because we're starting to understand that what these utility tokens actually represent is the utility associated with the strength of network effects inside that network. And so that realization is helping us to approach these things in a new way compared to the alternative, which is available to, say, equity and most other asset classes, which is discounted future cash flows. So the next project that I want to talk about is one that I've been advising, which is Tapatalk. And Tapatalk is a network of about 180,000 forums. It has an audience the size of about 300 million people. And they have a very important problem which exists in decentralized networks, which is that they don't have true identity information. And so it's very difficult for them to create incentives for good behavior around content creation, sharing, and consumption. And also, how do they enable peer-to-peer trade in a network which is ultimately trustless? And so it tells us a little bit about decentralized network design, that it's really, really important for Tapatalk to have a reputation system. And so in the context of their network, their reputation system captures 2 elements. It's about reputation at the content level, and it's reputation at the trade level. Another project where these kinds of principles of reputation have been applied is the Deep Defense Protocol, which is a cybersecurity protocol for IoT devices. And in this particular case, what the reputation system enables you to do is for people to earn, spend, and stake reputation on the basis of creation of AI algorithms, of auditing AI algorithms, and ultimately deploying AI algorithms into the network, and people benefiting through their reputation around the value that is being created in that network. And so a key design consideration for these networks and for DApps in general is that it's all very well to have trustless networks, and they're an important element of what we're talking about in terms of creating more scalable business models, but reputation is a key consideration in that design. Going back to the fan-controlled football league, the way that the economy works is that it has multiple layers of tokens but that perform a function in the network. Now, normally this would be a horrendous idea, excuse me, because what this would effectively be doing is diluting liquidity across multiple layers of the network and creating the equivalent of like a whole lot of shit coins. But in reality, what happens in the fan economy is that these tokens are all related to each other and in fact have a predefined relationship with each other and to a reserve currency called the fan token. Now, why is this important? Because what it enables us to do is to have people that participate at many different levels of the economy, but draw liquidity from a reserve currency, but also capture value based upon where they're participating and where value is being created inside the network. And we do use that or create that using a process called token bonding. And what token bonding enables us to do is to predefine what the demand and supply curves of each one of those tokens are and how they relate to each other, so that they're not operating independently of each other, but they're still capable of capturing value for market participants. KEDX is a crypto derivatives exchange in Gibraltar that I've been advising, and what we did here is something very, very interesting as well, because I spoke previously about this work function. Now, each work function also has an associated reward function, and what the reward function says is, based upon the work that has been defined, this is how the reward during that cycle of new coins will be distributed. And in the case of KEDX, what we did was we created proof of liquidity. And what proof of liquidity basically does is say, well, who created liquidity during that cycle? Because that was the key determinant of the value of that network. And we then said, based upon who created liquidity, new coins will be distributed based upon actual transactions that happened inside that network. And so another key design consideration for decentralized networks is that crypto assets are mostly no better than what we have today unless they have liquidity. So when designing these networks, it's really important to design in a way where you encourage additional liquidity. Augmentors is a game where I'm an investor, augmented reality game, obviously. It's currently in alpha. And what's interesting about this process is that we did this token sale at the beginning of 2017, and we've learned so much about non-fungible tokens over the last 2 years, because when this game initially came out, there was no such thing as a non-fungible token. And we're now up to the point where we have multiple standards supporting this idea of non-fungible tokens. So in the case of augmentors, each one of the playable creatures inside the game is a non-fungible token that has a record of everything that that non-fungible token has ever done inside the game and who's owned it and things like that. And so key consideration here for us is that non-fungible tokens are a really, really powerful way of storing asset records on the blockchain, and they're becoming more and more economical. Another project that I'm an investor in is Dialer. And Dialer is a set of protocols for enabling decentralized financial services. In its initial conception, it enables a general purpose cryptocurrency that has zero transaction fees. And what was interesting about this particular project is that right from the get-go, we paired it up with an application called Walla, so that users wouldn't be exposed to the protocol and the complexity underlying that infrastructure. And so in phase one, when we launched this, it was purely to test its utility as a medium of exchange. And we found that within 60 days of launch, we had over 100,000 wallets. The average user was doing about 3 transactions per day. And we had about 2.5 million transactions on the network over those first 60 days. And this will be extended now based upon the results that we got out of that initial use case, so that we now have the new protocols that are coming online that support this general purpose cryptocurrency and work with it, that enable lending, micro jobs, and also the purchase and sale of digital goods and services. And so crypto assets need application interfaces in order to be adopted. For most of 2017 and 2018, we focused so heavily on investing into protocols, and no doubt there is a good reason why that is the case. But unless you put an application interface on top of that protocol, you're not going to get the adoption that we need in order to make crypto assets go mainstream. So we have a very, very long way to go from where we are today. We're probably in 1994 if we use the analogy of we're creating the second version of the internet now. We do not know what this thing looks like in 2018, but we know that we're not in 2018 right now. And the fact that the prices are going up or down, the fact that I see that we're back up 20% between when I sort of got onto a plane and when I arrived here, doesn't really change the fundamentals of these decentralized networks and how they are a superior way of coordinating economic activity, no matter what's happening in the market right now. So I'm personally very bullish about the potential for this technology, especially its use in applications. And I think what we're going to find is that most of these projects initially will be funded in the next while using equity instruments until they have an MVP, until they have initial market validation. And then we'll switch to a mechanism where utility instruments will play an increasingly important way of creating the network effects and encouraging or influencing the strength of the network effects in these decentralized networks. And we're also playing with some very interesting hybrid designs that have security instruments that convert into utility instruments under different circumstances, or even security instruments that have predefined relationships with utility instruments. And so I think that the future of the security token is not quite as simple as just saying that this is unlisted equity instruments and that they somehow replace what is currently happening. It's almost impossible for you to use a well-designed security instrument inside a decentralized network in a utility function. So I think that we're more likely to see that there's going to be a relationship between those two types of instruments. The other thing is that we're getting better and better at pricing these things, and eventually we'll have a situation where the price correlations will start to disappear, particularly as you have more and more of these networks online, more and more user adoption, and more information about what the true value is of a network participant. I think that we'll see increased adoption of reputation systems, and we'll see increased adoption of non-fungible tokens as a store of information about asset records. Thank you for having me today, and I appreciate your time. Enjoy the rest of your conference, and I'm happy to answer any questions you have.
Here you go.
Sure.
Could you enlighten us with your present, past, and future collaborative exchanges with the regulators
Sorry, I'm struggling to hear you.
in times to come?
Could you maybe speak?
Yeah, what
Okay.
I'm trying to say is that could you enlighten us with your past experiences, present experiences, and future experiences and expectation when you are working with regulators, for example, central bankers? Why did they hate the crypto at first sight? Now, do you think that you could reverse that possibility into positive, objectivity and constructive kind of collaboration with them?
Sorry, I think that I think what I heard there was central banks are mostly against crypto at the moment. Do I think that it will
Yeah.
change in the future?
In the past, present, and future.
So I think that it's almost impossible to have this blanket view of what do regulators want and what do central banks want and what is their position on it. I think there are some countries that believe that if crypto manages to be successful, it's going to have a major impact on their ability to exercise monetary policy, and that they'd rather just kill it up right up front before it even has a chance to be successful. And then there are another group of central bankers which kind of say, we've got a large group of people. At the moment, there's about 3 billion people in the world that are not currently served by the existing financial system. And if we can use this new technology to create a more inclusive way of people participating economically, then that's not a bad thing. And so we might very well end up in a situation where you have this kind of parallel economy that runs on crypto and another economy that runs on fiat. And personally, I think that that's good for people. Right now, there are, I think, those two camps. And as to, do I think that everybody will come around to one side or the other? Probably not. But what's already happening is that projects are choosing to base themselves where the regulations are most favorable for innovation and for testing out these concepts. And I think that ultimately, those countries that choose to sit this out will see in 10, 20 years' time the impact of that lost opportunity.
Any more questions? Oh, right here. Oh, okay. Yeah, one question's good. Here you go.
Hi. Can you hear me? Okay.
Hi.
So in your capacity in Newtown Partners, does it take equity stakes in projects, or does it mainly invest in tokens?
We take a mix of both.
Okay, thank you. Just wanted to know that.
I mean, I can explain why. I believe that we don't yet know exactly where the value distribution is, and we don't yet know how to do decentralized governance properly. And so we are effectively saying part of these networks are going to be centralized initially and look like existing startup forms, and other parts will decentralize over time. And initially, we don't know what that is going to look like. Well, we don't know what it's going to look like in 10 or 20 years' time. And so we believe that it's important for us to play a role in both sides of that value accretion method.
Sort of a related question. If you do take, for example, security, like buy security tokens, has Newtown Partners discovered or planned any sort of exit strategy for this sort of thing? Because, of course, you know the liquidity in security token solutions tends to be very, very low and very difficult to access.
I don't personally think that there is a real market for security tokens yet. And I think that there are so many challenges with actually just taking something that is currently off the blockchain and putting it onto the blockchain that does not create additional liquidity. So right now, we haven't purchased any security tokens. And I think it reflects rather what investor appetite is more broadly and the availability of secondary markets. And frankly, the reality that there is no liquidity for these instruments yet. So that will change, but we're not there yet.
Take this one.
If you don't mind, follow up to my question there. What I want trying to draw your attention is the question of unilateral, bilateral, and the other thing, multilateral. It seems that the language on the chemistry is not on that tree platform. It seems to be very diverse and very, very distributed, completely non-aligned between the three ecosystem, within the, what do you call it, the regulatory, unifying factor, whereas the players, the consumers, and the offerer, it seems to be completely diverse. Do you see the possibility that we can bridge this impossibility into a possibility? That's exactly what I was trying to draw upon your past experiences and looking forward for tomorrow.
Well, yeah, the best analogy is to use the internet. So the internet was completely fragmented. It wasn't clear that an open source model would win out in the end. It's not even clear that the current technology underpinning the internet was the best option. But the point is that eventually everybody realized that the network is going to be better and more effective if we coordinate rather than if we try to do our own thing. So I think it reflects the immaturity of the industry more than anything else at this stage. And I think that we will figure these things out. But like I said, we're in 1994. We're not watching cat videos yet. We'll get there.
Thank you. Thank you very much. Llew Claasen, everyone.